Hello and welcome to this Tinubu and Trade Finance Global webinar, Credit Insurance, Export Credit and Funds, How Do We Solve the African Trade Finance Gap? My name's Dipesh Patel, editor at Trade Finance Global, and thank you so much to all of you joining from all corners of the globe. In today's interconnected world, the importance of trade in fostering economic growth and prosperity cannot be overstated. Yet the continent of Africa, home to 54 individual countries, faces a formidable challenge in realizing its full trade potential due to a persistent financing gap. The African trade finance gap, last reported to stand at $120 billion, is a complicated issue, exacerbated, of course, by the pandemic, an urgent requirement to shift towards sustainable trade and trade finance, challenges around access to dollar liquidity, and inflationary pressures from the Russia-Ukraine war. These unique challenges demand innovative solutions and collaborative efforts from key stakeholders in the global trade and financing ecosystem. So today, we're going to dive into the difficult yet important questions of why does the African trade finance gap exist? What are the main factors behind it? And what can be done collectively by many actors to solve this problem? They're not easy questions, and they do not have a single solution. If it were so easy, we probably wouldn't be doing this webinar, and the trade finance gap wouldn't be a challenge today. So we're going to have lively debate and brainstorming from multiple actors representing many different areas of the trade finance and the trade credit insurance ecosystem. And we're going to be discussing what we need to do to improve access to African trade finance. So today, I'm really excited to have a great panel of experts on the African trade finance from the African trade finance industry. I'm really happy to introduce our panelists, Dio Adesanmi at Standard Bank, Shui Hayashida at MEGA, Jerome Pez at Tinubu, George Wilson at Investec, and Richard Wolf at ICESA. Welcome all, and also welcome to our audience dialing in from all over the world. As you know, we're live on LinkedIn Live, on Facebook and YouTube, so we encourage you to ask questions, and we'll be typing the answers to your questions from the panelists live and in real time. And do feel free to tweet us and use the hashtag Tradecast to get in touch with us. So to start off with quick introductions, if you can give a quick background of who you are, what you do, and perhaps also what brings you onto this webinar. Jerome, I'm going to start with you.
Yes, good afternoon. After two and a half decades in the credit insurance industry, as well as in the trade finance industry, I set up Tinubu Square to provide the IT solution and services to export credit agencies, credit insurers, and notably to enable them to integrate better with the ecosystem which is required to provide financing to the economy and to secure B2B credit transactions.
Thank you very much, and thanks to Tinubu as well for sponsoring this Tradecast. Deo, over to you.
Yeah, good afternoon all. I have over 2 decades of experience cutting across corporate banking, transactional banking, and structured trade and commodity finance. For me, Africa remains a centerpiece of what we do at Standard Bank. It's an interesting continent. You've mentioned the diversity of the continent, and I hope to contribute positively to how we can move the discourse around how does Africa interconnect and feed ourselves with bulk of what it needs. It currently gets from outside. Thank you.
Thank you very much. Shu, over to you.
Thank you, Dipesh. My name is Shu Hayashida. I'm from MEGA, Multilateral Investment Guarantee Agency, a member of the World Bank Group. I'm based in Dakar as head of West and Central Africa, and I'm in charge of a trade finance product that we have just introduced for Africa. Nice to meet you all. Thank you. George,
over to you.
Hi, I'm George Wilson. I look after trade finance for Investec Bank. I'm a long-standing African trade finance practitioner, as well as being the ITFA Africa Regional Committee chair. where I champion a great deal on precisely this topic of the African trade gap and how to resolve it.
Thank you, George. And Richard, over to you.
So, Richard Wolf, great to be here. Thank you, Dipesh. I lead the International Credit Insurance and Surety Association, partly because I should have learned the trade. When I entered this business, my hair was still dark and a lot more than this. Now, we, as ICISA, represent the largely private credit insurance community and the surety community in the world. And that is really the world, but Africa is the next frontier. That's why it's interesting, and that's why I love to be here. Thank you.
Thank you very much, Richard. So now we'll go into an introduction and really look into the cause of the African trade finance gap. And Jerome, perhaps you could describe some of those issues and what the main drivers are of this problem.
Yeah. Thank you. Good afternoon, everybody. So the point, I think we want, when we want to get a clear picture of the situation of the African trade finance, it's good to first to have a dimension regarding the duration of the risk. The second one, the geography of the risk. Indeed, the situation is fairly different if you look at the long term, for example, project finance element, or on the medium term, for example, investing in an equipment or a facility for a medium-sized company, or if it's pure short-term credit. As well as it's fairly different if you look at the domestic market. I mean, the ability for companies located in the same country to enjoy usual credit terms, as is the case in other markets, notably fairly developed economies where it's a standard thing, or if you address the issue of the regional market, which for a company trading within the region or within the sub-region. And finally, when it's deep sea export. There are a number of things made available today already for deep sea export, so the situation is fairly different. Additionally, I wanted to just remind everybody that clearly supplier credit and customer credit are part of the standard processes for companies to develop their business and to trade. It's within the trade sector something that corresponds to the production, transformation, and distribution cycle. So each trade sector enjoy or implement its different credit terms. And it's important when a company wants to compete in a given environment to be capable to enjoy the same type of trade credit terms and to provide the same type of trade credit terms than the competitors in other markets can have. That's very important. That's the reason why trade credit insurance is potentially a solution, because it can secure those credit terms. So that's first picture I wanted to provide you with, and that the reason why I believe it's part of an infrastructure for a country.
Thank you, Jerome, and I think it really makes sense to talk about it from those three: domestic, regional, and deep sea perspectives. Richard, you're nodding. Can we de-risk some of the transactions of corporate buyers with insurance and use that risk cover as the basis for providing trade credit in Africa?
Oh, absolutely. I want to make one thing clear, though. Africa does have a finance problem, but Africa equally has a collateral problem. And if we in trade credit insurance can solve a large part of that collateral problem, we're solving the finance one as well. Now, those are not the only issues. Trade credit insurance is great at providing collateral, right? Because it can provide the financier with rights to the indemnification if a transaction goes wrong. But I think in order to do that, we need to solve three issues. And that's the issue of information, largely for the regional and the domestic trade, less so for deep sea. We surely need a solution to the issue of the rule of law. And that means the law of the land prudential regulations, but not only that, also how the courts see this and how the courts maintain this. And the last issue that we desperately do need to solve is predictability, and lack of predictability is caused for a large part by corruption. Now, these are addressed in the roadmap of the Financial Inclusion for Trade, which we might talk about later, of the World Trade Board. But I think, to answer your question, trade credit insurance can solve at least a part of this problem.
Thank you, Richard. So Deo, I guess Richard summarized, information, the rule of law, and predictability as those three parts. Do you agree, or what, in your opinion, are some of the main barriers to these unaddressed issues? And are you seeing, what issues are you seeing with regards to local banks and provision of trade finance to MSMEs? And finally, does this differ in different markets?
Thanks, Dipesh. I agree wholesale with the views shared by Richard. And this is why, as a result of those views, you find out that medium, small, and micro enterprises are categorized as between medium to high risk. And it's not just a function of the environment in which they operate. It's important to note that the information, the quality of the information, you need to make a judgment call on a credit exposure to this market segment, coupled with the fact that there's high operational risk. Some of these counterparties do not have a track record and do not have experience, which is why oftentimes banks adopt a structured perspective towards granting them credit. Banks are looking at the quality of the off-taker, the quality of the ecosystem, and in all, this leads to a higher pricing compared to what a multinational or a large local corporate in the same market segment is offered. So it's important we look at this from the sum of the parts and not just as a standalone. Thank you.
Thank you, Dio. George, how do we address the African trade finance gap? And perhaps you can bring up some of the, at a very high level, the key findings from the IFA white paper.
So, I mean, addressing the trade finance gap, intuitively, you kind of need to start, if you're going to solve a problem, you need to look at its causes and resolve those causes. So, it's well understood. There's some great AFDB research, as well as some ICC. There was a whole 100-page pullout, particularly on the trade finance gap in 2016 in the ICC trade supplement, and there it's very clear that the trade finance gap is what it is at its heart is the inability of African traders, African merchants, to obtain financing, the trade finance, the trade credit from their banks, right? So that is the cause, that is what it is. The reason and the root causes for those banks not providing trade finance is because, as Deo's kind of indicated, it's hugely expensive. There's a lot of regulatory costs, both from a liquidity as well as an RWA credit cost, that makes this type of trade finance completely unprofitable for those banks. And aside from the deep sea category of trade that Jerome mentioned and spoke about, it's really that regional and that local domestic trade finance where the vast majority of the trade finance gaps comes from, and it's very much in that MSME space that Dio was talking about. All of this is well understood and well documented. The issue is, what do we do about it? And it's really around the provision of risk capital directly into that space through the African banks. Only African banks can touch an African trader, even a local corporate, but certainly the MSMEs and the informal sector. Only African banks can do KYC on them, review and assess their credit, and importantly, take local currency security over their stall or their stock, right? So we really need to address, if you're going to address the problem of the trade finance gap, you really need to address the provision of risk capital directly to where it is needed, where it is going to make the difference, and actually reverse the gap. And trade credit insurance certainly can play a major part in that. It just may not be the intuitive view that people outside Africa assume that it will be an analog of trade credit risk insurance over non-African or developed market type trading activities. Importantly, you have to use the banks and the local banks as aggregators. And if you can use those as aggregators, you can cover their risk, wrap their risk with insurance, and greatly increase the amount of liquidity directed precisely at this sector in order to turn back the tide.
Thank you, George. So problem of risk capital and local bank perspective needed. Shu, is this what's your view? Is this problem better approached perhaps from a regional level, where solutions can be addressed at a kind of sub-sovereign governmental or FI financial institution level? And how can we also deal with the big challenge, which is the local currency and USD clearing liquidity challenge?
No, thanks, Dipesh. I think the problem needs to be addressed at various levels with different parties and of the industries. As Jerome just referred to the difference between regional and international segment, but I also think there's also a difference between pure private sector transactions versus sovereign type of transaction, where government, sovereign-owned financial institutions play an important role. So from that perspective, I believe we also have to sort of act at regional level by working with the government, regional multilateral financial institutions, as well as sovereign-owned banks, financial institutions, and African commercial banks, as some of us already referred to. So these parties, as George also mentioned, indeed know where the demands and gap are. They will be able to do the KYC and all these things. And in national institution, in national banks, in a national institution like ourselves, we'll be able to leverage on them. I think that's the leveraging model that we need to pursue in this area, in this continent, such as Africa. And it is also important to think about the local currency financing, as George also referred to, where possible, and currencies such as ZAR, CFA francs are the obvious candidate in this space. And MIGA will be able to provide trade guarantee to enhance trade finance transaction in this area.
So quite a few different solutions kind of discussed by the panel, and we'll go on to talking about them a little later. Richard, I want to pull on your first point around that 5-point plan. I guess can you explain the World Trade Board's financial inclusion of trade pillars with regards or with a lens to fixing that African trade credit problem?
So the World Trade Board is a nonprofit organization with some pretty high-powered individuals, I might add. So, for instance, it's chaired by no, it's not chaired. The special advisor is Pascal Lamy, who is the president of the Paris Forum, but also the president of ICC is in there. And what they published was a document called Financial Inclusion of Trade. And they said, in order to solve this specifically for Africa, we need to look at 5 points. And the first point we need to look at is the legal and regulatory infrastructure. Now, that was already said a couple of times. What additionally the infrastructure element that is very much needed is the data infrastructure. So things like encouraging e-invoicing, and we might come back to that. The third point is data infrastructure. So increase the data points of everything that has to do with trade, and it can be domestic, it can be regional, it can be deep sea as well. And all of that is supposed to see to the acquisition of new funding sources. That is very much in a nutshell what the World Trade Board has said, and they are working on this quite hard, and it seems to make sense. As far as I'm concerned, they are 2 steps ahead of everyone else, because they're not only saying there is a gap, yes, there is a gap, they're also saying what we can all do about it.
Thank you very much, Richard. And I think I've been jotting all of those down because I think that forms quite a nice basis for the structure of the webinar. And I think maybe we can tackle each bit point by point, because I think everyone has quite a lot to add. So let's start with talking about digital infrastructure, and Richard, perhaps if you can continue, how can the implementation of some of those digital tools, legal entity identifiers, e-invoicing, actually contribute to improving financial inclusion in trade for African MSMEs?
So at the beginning of this webinar, I said for the trade credit insurance community, there are 3 issues. And creating a digital infrastructure solves at least 2 of them, and that is information and predictability. So it's of tremendous importance to track the flow of goods and of payments. And this can be used as information later on the creditworthiness of buyers. What we need is a systemic way of capturing this data. The basis of this is knowing who the transactional parties are. And that in a number of economies is quite a big issue. But there is a solution there as well, because the World Trade Board works together with the organization that publishes the legal entity identifier. So we can see on a one-to-one basis who is the seller, who is the buyer of goods, and we know it's them and nobody else. And that's important if the Chamber of Commerce registration, which is so common amongst OECD countries, does not really work. And that is the case in Africa, or at least in a number of economies in Africa. So e-invoicing can put a lot of flesh on the bone. It can show who traded, so who is the seller, who is the buyer, how did the flow go, how did the payment go, and if that payment went well, that is an essential data point for my community in assessing the creditworthiness of the buyer.
Thank you, Richard. Very interesting. And Shu, I'm going to come to you now. To what extent the use of proceeds is important from a DFI point of view? What tools perhaps could be used to help understand that use and the flow of funds, and how will this help increase the market for African trade?
Yeah, no, thanks, Deepesh. I think the way MIGA and maybe other DFIs deal with that issue of, let's say, use of proceeds and information around that at this point in time is to be very flexible and to just apply the sort of exclusion list of goods that we cannot trade, such as weapons and coals and things like that. Otherwise, we have to rely on the representation of the borrower. That I think that's the reality. Otherwise, it doesn't work, right? We can't check every single document ourselves. However, from DFI point of view, and maybe from international banks and entities who don't have local presence in every single country, and I think understanding of the use of proceed in a remote manner with digitalized data could be very helpful to qualify the impact of the transaction, the impact on the local economy, society, the sort of ESG type of impact. And that may affect appetite of the banks, DFIs, and let's say climate finance and things like that are other good examples. And also let me also add that this is important from the integrity, anti-corruption type of standpoint, to assess the information on the borrower and the parties involved. And in terms of tools, I think I have seen some of the matching platforms of trade, which collect data from transactions. And yes, the information on through these platforms and on the borrower and all the parties are important. But the data collection needs to be done in a very efficient way. I think that's a key point. Otherwise, it would create unnecessary burden to all the parties involved. Thank you.
Thanks, Shu. I guess the main question is, can we use technology to check every document? So Jerome, Tinubu has grown his platform using emerging technologies to provide credit insurance, surety, ECA software. Has the adoption of these technologies helped really increase access to trade credit, or is adoption still too slow to make a noticeable change?
I think I would provide probably a bit more optimistic view on this, if I may. I mean, with Tinubu for 23 years, I have helped setting up export credit agencies and private credit insurers in different countries. I did that as well for decades with Euler Hermes, starting operation in some countries. Plus, I would say my years of experience in trade finance in Nigeria for several years made me believe that it's feasible. It's feasible now. There's the technology that makes it easier than 25 years ago when we wanted to set up a credit insurance company in an emerging market. Today, I believe that, as Richard mentioned, there is an issue of the rule of law. It's a real thing. But the overall credit insurance will start in an environment the day there is a real willingness with a long-term perspective to set up an organization that will be capable to have access to a reasonable level of equity and reinsurance is ready to provide capacity. The day you put in place the adequate technology, and it's feasible, it's achievable, the day indeed you start the chicken and egg to develop intelligence in terms of data, knowledge, assessment of the obligor, because clearly, and that's something that has to be understood in the environment, credit insurance will develop when credit insurer is capable of assessing a risk on the obligor, and as well as subscribing policyholders on locally insured in a given market. That's a condition, okay? And then developing professional expertise in that market in terms of commercial underwriting, risk underwriting is feasible. So the elements, it's feasible with a long-term perspective, with a long-term commitment in any market in Africa to develop that capacity and that infrastructure. Technology makes it quite feasible now. Of course, the cost of the risk will remain higher than in other environments, but over time that will reduce.
Thank you.
Could I?
Yeah.
Sorry, Dipesh. I'm just to jump in there. Look, I obviously agree that that digital is the solution to global and perhaps even global developing markets trade finance ailments, but Africa isn't ready. I mean, this kind of has to be, certainly in my opinion, a longer term proposal if you're going to go down to the individual details of every single invoice, right? And there are two major problems. The first is that 600 million people in Africa, on the African continent, have no access to any electricity at all. It's not just South Africa with 12 hours of up to 12 hours of load shedding a day, there is no infrastructure available to the vast majority of that 600 million people, and you actively kind of don't want digital LEIs in those circumstances, because it actually becomes a hindrance and an interference to trade which is functioning in a very manual, analog way at the moment, but it is at least functioning. The second point is just the sheer scale, particularly if you're talking about the MSME sector. There are 30.7 million MSMEs in Nigeria alone, each with hundreds of trade facilities, with thousands of invoices, right? I mean, it just multiplies out to an impossible scale. And then there's the provision of the actual digital infrastructure and the electricity to power all of that. It's certainly the right direction, but I would argue that Africa is not ready for that yet. There is an alternative solution, rather than trying to go right down to the bottom layer and hoping for the digital inclusion of hundreds of millions of SMEs. You could again use the banks, their providers of trade credit, as aggregators. They do have the digital infrastructure to use the kind of Tinubu solutions, etc. And if you can use them as an aggregator, apply the credit insurance to their trade credit portfolios of these kind of trade finance, you could directly improve very quickly, almost immediately improve a lot of those trade financiers on the continent.
Thank you.
If I may react to that one.
Yes. Go ahead, Richard. I will have a comment afterwards, if I may.
I'm not sure how feasible it is to ask of at least the private market to take that model of being behind an aggregator. And the reason for that is that in the past, there have been a lot of checks written, a lot of scars on backs using aggregators such as financial institutions. And basically, the trust is just not there. So while it makes perfect sense, George, what you say about finding a solution quickly, it takes two to tango, and I don't think the private market is ready to tango.
Yeah, I agree with Richard. I have another element of comment, if I may. In all the markets where I've seen the beginning of trade credit insurance supporting trade finance, basically it was to address 10% or 15% of the company that usually represent 70% of the B2B trade credit within the country. And it's not to address the 37 million companies in Nigeria to start. It's to be capable to have an offering on a solution, to be capable to provide credit insurance capacity and contract to maybe only 10% of those companies, those medium-sized companies that really are the potential for the coming 5 years of the development of the local economy very strongly, and to be capable of assessing not the 37 million companies, but the same, potentially the 100,000 companies that represent a significant part of the order received by those medium-sized companies within the environment. And that is definitely the mission and the job that the trade credit insurance can do in a given country. And certainly in collaboration with the banks, but that can be done.
Thank you very much, Richard and Jerome, for your comments. And perhaps let's now move away from the digital pillar and let's go on to the next pillar, the legal and regulatory infrastructure. A question from the audience here, and Di, I'm going to direct this at you. But will the African Continental Free Trade Area make a significant impact in advancing access to capital and flow of goods? What's your opinion?
Well, Deepish, I think that would be, and I think key lessons we have learned from the pandemic was the breakdown in the global supply chain construct. And I think that has led to the need for Africa to be self-reliant and also interdependent. So after, as it is structured right now, would help to dismantle the barriers you have within Africa, barriers around duties, free movement of goods. You need to understand right now that there are different economic blocks like ECOWAS, COMESA, SADC, EAC. They have different product standards. If you look at some countries with petroleum products consuming 10 ppm, others 50 ppm. If you have a common free trade area, you create a bigger market, you create a scalable market, and you create processing capacity. If you look at the construct of Africa's exports right now, a lot of them are raw materials and intermediate goods. So it allows for you, for instance, Africa imports $100 billion of refined petroleum products from Europe every year. But if you have refining hubs, or if you have regional hubs where Africa is able to produce for itself, it creates security of supply. It allows free movement of goods. And imagine that a lot that has to do with freight costs, moving from Asia, moving from Europe is eliminated. And by so doing, on the back of that, a settlement system would evolve, and eventually you could get to a common currency and other aspirations.
Thanks, Dio. I guess it's all around how we scale into African imports and exports. And I guess that leads me on onto my next question on scalability. Perhaps, Jerome, do you think that additional legal and regulatory infrastructure could provide security to reinsurers and insurers who are perhaps apprehensive to enter the African market?
It's clear that reinsurers are ready to provide capacity as long as there are some conditions which are complied with. Clearly, the issue of governance, to be sure that the credit insurer will perform according to the standard of the industry, and will follow in terms of ethical behaviors, in terms of control, the standard rules. Second, as long as the regulatory environment indeed ensure the fact that there is a continuity, a stability. Richard mentioned predictability, that's important in terms of legal environment. I think that, as it was mentioned earlier, there are significant improvements in the cross-countries trade with better legal environment to ensure that your asset is recognized by the other country, that your debt is recognized, and your ability to act legally has improved. So things are improving step by step. It's very important that everybody contribute to that. That's also one of the elements for reinsurers and insurers that will be considered for them to invest on the long term. And the only way it could work is with a long-term commitment.
Let's now talk about the third pillar, which is all around data and infrastructure. I think that flows nicely on from the first two parts of the conversation. Richard, what's the right balance between providing African companies, specifically MSMEs, with sufficient capital versus insurers and reinsurers having enough risk information about the clients? And how, in your opinion, can data technology help create this balance?
Well, I think here, this is the question of creating the preconditions that enables insurers to do what they do best, and that's enabling trade on basis of meaningful information. So Frexim Bank understood this, and they're in the process of building a large data depository. And that will in part provide that information, which will give insurers and their reinsurers the possibility to look and the possibility to assess that risk in order to provide the collateral I talked about, which means the banks probably local banks are able to provide the financing. So I think that is kind of the balance, the precondition. And the other precondition is probably how can that data be so transparent that corruption is made a lot more difficult. Now, we know that corruption thrives in the dark. The more transparency you can provide, the less you will have the corruption problem. And I looked this morning at the Transparency International Index of perceived corruption. And it is frightening to see that in the lowest 80 of the 180 countries that Transparency International assesses, 34 of them are African countries. Of the top 50, it's only one. It's Cabo Verde. Now, according to the United Nations Development Programme, poor governments and corruption are major bottlenecks for the development of economies, of trade, and reduce inequality by a long way. Now, as we know, trade, especially from MSMEs, reduces that inequality. So my plea is more transparent information, not only for risk assessment, but also for fighting of corruption.
Thank you very much. And Jerome, what's your view? I mean, obviously on that, the aim here is to improve predictability, i.e. corruption. How should the industry approach building and improving that data infrastructure and kind of improving that data flow?
Yes, I mean, in some countries, what worked very well was the setup of an organization independent from the bank individually themselves, a body where the bank could deposit their information or transfer part of the information without this information providing benefit to their competitor. The experience is that the bank had difficulties to share between each other information, but could potentially provide that information. It could be it could be a central bank, for example, that can gather some of this information, make it available partially to assess the risk. It could be a trade organization. In some countries, it's a chamber of commerce where it was done, where they decided to force companies to provide information. Companies register as well. All those elements of information enable step by step to build a knowledge and intelligence regarding the risks. And as I mentioned earlier, it's a chicken and egg, which means that if you start providing trade credit assessment and cover, step by step through information you got from indeed the receivable you have guaranteed, the buyer you have guaranteed, you develop your knowledge and you develop at least an experience of payment on some of the players. And this portion at the beginning is small, but it expands step by step. That is feasible. And today, to structure the data is relatively cheap. To get the database structured and available is something which is very feasible. It's essentially the willingness of different parties to collaborate and to feed that data.
Thanks, Jerome. I guess the difficulty is technical assistance, which now leads me on to the fourth pillar, as per Richard's introduction earlier, around technical assistance. And perhaps, George, I'll come to you now. What measures of support can be given to MSMEs to ensure that they are given more capital, have the most pertinent information, actually know how to access this? And how can this be impacted with different length or different size facilities? I know we talked about, large and lumpy facilities versus lots of, smaller short-term facilities.
Unless things change, they won't change. That sounds like a foolish truism, but if we're expecting, vast numbers of very granular individual SMEs across the continent in 54 countries and 42 currencies to universally come together and seek out assistance in the form of technical assistance so they can fit in with the expectations of the international community. I'm afraid that's not really very realistic. We've had this kind of problem before in Africa. There's a thriving trade refinance business which requires all of that information, but that only works for very large, lumpy, longer term trade transactions, as we've discussed before, and it doesn't work and cannot work for all of those hundreds of millions of underlying SME and MSME, a lot of them informal traders and their transactions. If we expect them to all universally move together towards what's required from the international private sector, no amount of technical assistance is going to achieve that. We're talking enormous scales of geography, and really, again, the only organizations, and they're extremely professional and very smart people. They're career professionals in these banks in Africa who have been providing exactly these facilities for decades. They're the only people who have the boots on the ground to provide any kind of technical assistance, and they do. They're just constrained around how much capital and liquidity they have available for these types of SME trade, because they're just unprofitable for them. It may be the other way round. Everyone is, and in our ITFA paper, we talk about the need for training and communication and information. And I think everyone just immediately assumed that was from the outside and from the international community telling Africans how to do trade finance. It's probably actually the other way round. And there is certainly need for training, but there's also a little bit of a hearts and minds problem. So we encounter exactly the same issues with this kind of transparency and information requirements around ESG and sustainability. And quite frankly, your average trader and even more so your average African bank has very little interest in that, because they just don't believe it, and they don't believe it to be a realistic solution for them. So they try and solve it themselves in other ways. If the bar is set too high at the start, it will, I'm afraid, die stillborn as a program in reality.
Thank you, George. Dio, do you agree there? And what are your thoughts?
So I kind of have a divergent view, and I think there is technical assistance, but the language in which it is being communicated is not the language of the market participants. So we need there's a lot of work that has been done by multilateral agencies, but is there awareness of what has been done? Is this in simple, understandable form of communication? Are we speaking to the right target markets? So it's important we work with focus groups, like working through chambers of association, chambers of commerce, trade association. And beyond that is we need to create pilot and anchor programs. We know the high flyers and outliers of the market. So a lot of theory needs to be put into practice. And I think one thing we also need to do is a feedback loop. We need to find out how periodically do we measure success. It's not, you find out that programs are started and discontinued, but how do we measure success? So there's a need to review a lot of this technical assistance to find out if it is getting to the persons it is designed to get to. And I think for me is, let us move from talk into action. Let us have pilot schemes focused so that from those pilot or demos, we can know what needs to be improved, what we need to build on, and we can now come up with a revised form of technical assistance.
Thank you, Dio. Shu, I guess, you know, representing a multilateral. What's your view? How has MIGA approached the government or sub-sovereign clients and provided assistance, and also communicated about this? What would your view be on a successful approach?
Oh, thanks, Dipesh. And first of all, I agree with what Dio has just mentioned, that we need to create a successful pilot case, which obviously can be duplicated in different jurisdictions. So at MIGA, as I explained, we deal with the government, sub-sovereign, SOE banks, etc. So regarding our transaction with African governments, as well as sub-sovereign entities, we have, first of all, tried to identify where the bottlenecks are for the access to the trade finance market, especially the finance market. Either it is due to the cost or an exposure issue by the financiers, or just lack of information on the tools that they could utilize. And we sometimes even facilitate the execution process with the government and sovereign entities alongside the commercial banks to make sure that we have a successful pilot case. And as Dio mentioned, it's important that we disseminate that information of success so that as similar entities can duplicate the transaction. Yeah.
Thank you very much. Makes sense. So now let's go on to our final pillar, which is really talking about the most important piece, which is new funding sources and areas for trade capital to be deployed in the market. Perhaps I'll turn it on its head first, and Deo, I'm going to ask you if you've seen any examples of failed efforts to inject liquidity into the African trade finance markets, and what future sources might be able to learn from these failures. Sorry, challenging question.
Yeah, you're putting me on the spot there. And for me, without mentioning names, there have been several interventions. You've had on-lending facilities from DFIs. You've had some of them provide credit insurance cover. You've had some of them try to incentivize the banks to lend. So if the credit risk is bad, regardless of the source of the liquidity, the banks might not lend. But if the banks know that they are covered or wearing bulletproof vests, where there's some form of risk sharing. But I think in the world where we live today, with liquidity from Europe drying up to Africa due to ESG concerns, and very aware that Africa is a major producer of primary commodities, I think we need to work with digital platforms. So if you're having the emergence of trade funds, people alternate sources of capital, even though some of them are targeted towards high risk. But as you have a pool of dedicated fund disbursed via digital platform, it makes the processing of the credit faster. And I think ultimately where we are looking at is a case whereby if the banks are incentivized the right way, over a period of time, the cost of the funding itself and the cost of capital would ultimately reduce, and you would have a market where participants with track record become the star boys of the industry. Thank you.
Thank you very much, Dio. Jerome, what strategies and steps would you recommend for expanding the credit insurance market that could provide guarantees to sellers or banks in Africa? Perhaps to your point earlier, targeting both those deep sea companies and also domestic transactions. Is there also a role in governments to help secure some of those funding streams?
I think that definitely trade credit insurance can play a significant role to facilitate trade finance in Africa, but it will take place only when local body capable of underwriting credit insurance policy autonomously, assessing the risk of the counterpart, which is the buyer risk, locally will take place. And that will require clearly equity, and reinsurance can come along with equity, but equity with a long-term perspective, something not too much ambitious, but pragmatic with that long-term perspective, and very likely with the support of the government, local government, and I believe, and based on what George explained, the support of the banks that will understand that that there is an interest for them to help and to contribute setting up an independent organization, an independent vehicle, which will assess autonomously the risks and provide cover autonomously. And then to the banks, and then with the benefit of that cover to the banks, but an independent body. That will require the different parties, the government, the trade associations locally, the banks, probably the multilateral agency to help, and everybody teaming up to get that in place. Not too ambitious, pragmatic, step by step, and with, at the beginning, a limited number of insured and moving on, growing and developing and spreading the concept across the country over a period potentially of 10 and 20 years. But that is the way to do it.
Thank you. And Richard, I'm sure you'll agree somewhat with that. But given your role at ICESA, can you give any examples of developing and emerging markets where you think initiatives such as these may have worked?
So building on what Jerome says, because I agree with all of it, what we've seen working fairly well is partnering with banks and partnering with factoring companies, because the one missing link that we have not addressed yet is distribution. And especially in countries where the infrastructure is not great, or the country is just clearly large, you need both distribution channels. Now, where I've seen that work really, really well is in Colombia, where what would it be, 20, 25 years ago, credit insurance came to be, partly as a result of private industry taking initiative, but also partly with government support. What we've seen there is a highly developed market based on that infrastructure, based on that distribution. And guess what? It works. But it's not going to be from today to tomorrow. It does take time.
Thank you very much, Richard. And I'm just looking question from the audience, and Shu, I'm going to aim it your way. Shu, what's needed for new players to enter the market and provide additional liquidity and financing to African governments and companies and also MSMEs? And how does the industry need to reframe the issue of the African trade market?
Yeah, no, thanks, Dipesh. So from sovereign transaction point of view, right? I think it is important that institutions like ourselves, DFI, increase awareness of the tools available, as well as the activities that we are undertaking. Not only the primary insurer of political risk, but also we also act as in the trade finance space, providing full cover to the financial institution, but also we are working with the reinsurers behind ourselves, behind the scene, where we can effectively increase the capacity of the transactions. We also need, I think, to understand, as mentioned by Jerome, I think the difference between ECAs, what ECA offers, and what other institution and offers in this space, such as DFI with untied financing, short tenor products, etc. And the use of proceeds, that, as we discussed above, is also very relevant. And one last bit is we also have a product like capital optimization for international banks operating in Africa, where MIGA provides its sort of political risk and expropriation risk cover to the reserve of the banks at the central banks of each of the country, and this allows a capital relief which the banks can use for trade finance purposes. So we have different tools which are available, and our sister institution, IFC, also offering a platform for trade finance. And I think it's very important to understand the tools available for them. Thank you.
Thanks, Shu. And another question from the audience. Should we look at accelerating the development of trade finance as an asset class? George, perhaps you could answer that.
The answer to that question is a definite yes. We should accelerate it globally, but it's particularly important in Africa. We're talking about such huge scales of such diverse and incredibly granular trade flows. It's just the nature of trade finance. There are these very, very small, very short tenor transactions, but millions of them. And if we can solve that granularity problem and create a stable asset class, then that is the solution to a $120 billion problem, right? If we can package, and somehow get our hands around these very gaseous facilities and assets, and get them into a shape that investors can actually absorb and swallow in the form of notes or fund investors, alternative investors, it's precisely the right kind of stuff. We can invoke SDG 17, and partnerships where we bring together insurers, multilaterals, the banks, and package large portfolios of these types of assets together, and get scale from the insurers and from the multilaterals, and then get further scale by packaging up those assets and selling them to investors in this new trade finance, or even sustainable trade finance asset class. Then that is very clearly the only hope that we have. Something has to change, and this is the right kind of change and a believable solution to such a big problem.
Thank you very much. And Thea, do you have any comments as, I guess, the other banker in the room?
I think for me, I would caution against importing wholesale foreign systems into Africa. Whatever we do has to be adaptable, has to be in collaboration and partnership with local stakeholders, meaning the market participants, regulatory agency. In a lot of the African countries, there's a need for advocacy because you do not even have local laws for certain trade classes. So it's important that there's that collaboration, that there's partnership, there's adaptability, and finally, like George was making reference to, sustainability. So you could have the initial liquidity come from DFIs, but by the time you begin to securitize receivables, which is the extreme end of the trade finance asset class, you create a recurring decimal that has a life of its own and can sustain itself. And at that case, at that point in time, you can win that particular target country of DFI assistance, and you would have perpetuated an industry like you have in Colombia and India right now. Thank you.
Thank you very much, Dio, and we are almost out of time, and I'm going to give the panelists about 60 seconds to think about what their final message is to the hundreds of people listening from all areas of the trade finance and trade credit industry. And look, there are so many things we've covered today, from the fact that yes, it's a cash problem, but the bigger problem is that it's a collateral issue. We've discussed digital infrastructures and whether or not e-invoicing, legal entity identifiers could be the way forward. We've discussed the complexity of the legal and the regulatory infrastructure, but the need for collaboration and partnership is absolutely paramount. The comms piece, or technical assistance, is incredibly important. We can have all of the infrastructure, we can have all of the assistance, but if we don't have capacity building, education and comms in place, we're not going to be moving forward to educate these millions of MSMEs, financiers, insurers, etc. And finally, we've debated lots of new innovative financing solutions, whether there are the needs to create independent autonomous bodies or grow the asset class, the trade finance as an asset class. So that's a kind of brief summary, and I'd like you all to kind of present your one take-home message to the audience. Dio, I'm going to come to you first.
I think for me, on a parting note, it's time to leapfrog into African trade. We can achieve that using digital tools like e-invoicing. We need to create a sustainable regulatory framework, and most importantly, create liquidity on the back of credit insurance. Thank you.
Thank you. Richard, emerging frontier, what are your concluding remarks?
I don't want to repeat what Deo said, because I agree with that. All I can say is in 25 years, I hope to be sitting around the table with you five gentlemen, asking the question, what took us so long? It wasn't that complicated after all. That's my take home.
Thanks, Richard. Feed for thought. George, over to you.
So I'd certainly recommend, if possible, that we look to African solutions for African problems, and really look to understand the mechanics of this real type of short-term self-liquidating trade finance. It has a huge potential for developmental support across these economies that desperately need it. In order to do that, I'm afraid that everyone involved needs to look to African solutions for those African problems, and release some of their Western confirmation bias. And things may work very well in other parts of the world in a particular way. We need to tailor some of those solutions specifically for Africa, rather than trying to impose them on Africa, and that will succeed. And I hope to have that conversation with you in a shorter space of time, Richard.
Thank you, George. Shu.
Thanks, Dipesh. I think I agree with everything which has been said, and I think from my perspective as MIGA, I think we believe that the African continent rely a lot on government, still on SOE banks and etc. Either from credit standpoint, fund flow, KYC, etc. And I think the leveraging model on those the sovereign entities, but also including the African banks, as I mentioned, who are very close with this institution and with the market, have a big role to play, I would say. And then more and more we'll have tools, such as DFI's tools, and as well as digital infrastructure, which would then boost the transaction. And also it is also important to mention that trade finance as asset class has a good credit standing historically. So it's a good asset class to think about distribution in the near future as well. Thanks.
And last, but by very means not least, Jerome.
Yeah, so I fully agree with what you said. It's feasible. That requires a long-term perspective. It should be a local vehicle, a local body, because it's in the word of business intelligence, which requires to have the foot really in the market. Don't be too ambitious. Then, for example, start with export and regional trade and move to domestic. Could be marginal at the beginning. Focus on medium-sized company and spread it step by step to a larger spread of companies. So feasible. And as Richard said, I hope that in 25 years we meet and we realize that it was feasible and we could have done it faster.
Thank you very much. And I guess the call to action is it perhaps should be less than 25 years. But I think the kind of key theme, weaving all of these together is African solutions to African problems need to be the approach here. First of all, I would really like to thank all of the participants who have joined us from all around the world. And scrolling through the list, I can see we have associations, we have representation from vendors, practitioners, banks, insurers, reinsurers, ECAs, governments, and of course we haven't had time to answer all of your questions, but we will be reaching out to the webinar participants, and I'm sure you'll all be very happy to write a couple of answers to the questions down, which we will be publishing. This webinar will of course be available very shortly on our African Trade Finance Hub, which will be on tradefinanceglobalcom/Tradecast, and that will be available very shortly. So please do keep sending through your comments and your questions, and we'll have a lot more information up on the African Trade Finance Hub. I would really like to thank Jerome and Tinubu for sponsoring this webinar, and thank you for making this possible. And finally, a huge thank you to all of our excellent speakers, Dio, Shu, George, Richard, Jerome. Thank you. It's been a pleasure. I'm Dipesh Patel, your host of Trade Finance Global. Good night.